Hello everyone, Steve Lentz here with Discover Options. Welcome to this presentation of scanning for butterfly and condor spread candidates. It is July 8th, 2013. Presented material is for educational purposes only and should not be construed as personalized financial advice. Welcome everyone. Have a real good class for you here today. We're going to use some OptionVue tools to go over a very interesting topic. It's something that we use continually in our mentoring course. And here is today's outline. First, we're going to study implied and statistical volatility. We're just going to kind of breeze over it. Some of you I know have a thorough understanding of both concepts. All right, some of you are just kind of getting introduced to both of those, and so we're going to try and find a happy medium there. I'm just simply going to go into OptionVue today. I don't have a PowerPoint except for this breakdown here. So we're going to go into OptionVue and really, move around quite a bit in the volatility charts. Now, something I want to enter just before we get going, I want to kind of give you a preview a little bit. I'm using a beta version, a test version that's kind of going around the office right now of the new modeling that we have in OptionVue that models for the horizontal skew. So those of you that are advanced in options trading, I think you'll appreciate this. We're going to come out in our next upgrade of OptionVue with horizontal skew modeling. I'm going to show you just a brief little portion of that, and I think you'll find that very interesting. We're going to take also a look at the importance of trending statistical volatility. We're going to go switch over to OpScan. I'll show you how we can scan for good butterfly and condor underlying candidates. And then we're going to, in case you don't have OpScan fired up, I'm going to show you how to just simply whip through a bunch of charts and scan those looking for the parameters that we're going to discuss here. Okay? So, without further ado, now I'm being bothered by my little cell phone. My smartphone is making all kinds of racket here. So I'm going to turn the volume all the way off, just so I don't get distracted here. Sorry about that. All right. Very good. All right, so I'm going to share with you my desktop. We're going to go over to OptionVue. Ta-da, there it is. Okay. And let's see, we're looking at some indices up here, and I'm going to fire up the Russell. I'm going to click on the $ RUT. We're going to bring up the volatility chart here, right like that. And I'm going to superimpose the price chart. In an OptionVue, we have two buttons, top left, right here. And I think you're kind of looking at this. So we're looking at the weekly bars at this point, and that's fine. Let's just sit right there. Actually, let me kind of zoom in just a squeeze. Let me bring this in right like that, okay? Perfect. Now, intermittently, I am going to get a sip of coffee here just to clear the throat. We don't take a whole lot of commercial breaks here too much where I get much of a break. So I kind of intrude and will routinely just ask you for your patience here. Just a second. All right. Now, let's talk about implied and statistical volatility. This is critical because condors and butterflies are spreads that take advantage of markets that are channeling in a tighter range, or their volatility is low. The actual volatility of the underlying market is going down, or is low, or it's chopping around a bit. Those spreads do not do well when the market is moving in either direction at a high rate of speed. And so volatility is critical that we understand that, and so we have two types of volatility here. Now let me get out my little annotation tool so I can get into this. Get my little pencil, and I'm going to bring in the blue first. Okay, the blue line here is implied volatility. We call it IV. This reflects the volatility implied by the time premium in the options. Once again, it's the volatility implied by the time premium in the options. for that given chain. In this case, it's the options on the Russell 2000 index. This thing, by the way, trades over $16 million of options a day. That's pretty good. That's pretty good. So that's what the implied volatility blue line is. Now this number now in OptionVue, and this is with our new our new upgrade coming out. These vol charts here show a 30-day volatility number, standardized much like you'll see in the VIX formula that the SIBO puts out, $VIX. That's a running 30-day number. It's over here in OptionVue. I have it kind of dialed up on the left in the quotes display. And so that's what you'll see is the blue line here. Okay, now let me switch colors and let's talk about the red line. The red line here is SV, or statistical volatility. Statistical volatility has nothing to do with the options. Okay? It instead is looking at the underlying asset itself and is looking back at the previous month and determining how volatile it has been. Okay, now let me switch over. I'm going to switch over to the daily so we can just kind of get a better feel for this. Let me get back to my, there we go. Go back to the pencil. Okay, we're looking at statistical. All right, so this is statistical. Statistical is looking back at the previous 1 month or 20 days of trading and looking, now in OptionVue, we look at the high and the low of each day, the range of each day. Other programs will look at what's called historical volatility, and they're looking at simply the close-to-close numbers. Okay? In other words, how volatile it is on a close-to-close basis. The algorithms are a bit different. Okay, quite a bit different. So in OptionVue, we find that a more reasonable determinant of volatility is looking at each day's high and low. And then we have this algorithm that is exponential in nature. We're weighting the closer days up front than we are the distant days, kind of like an exponential weighting, if you will. Okay. Now typically, let me get rid of this again. Okay, now just watch this. Look at the red line. Forget the blue line's even there. Okay, and just take a look and notice how the red line typically is moving up, okay, when the market typically moves down. Because in the Russell index and many other equities and indices, okay, in down moves, the daily ranges are much wider than in up moves. See that? Okay, so when the market is moving down, you have larger range days, and the SV line typically is going up. When the market is going up, the ranges typically are lower or smaller, and the red line, statistical, is going down at that point. See that? Okay, so that's statistical. We're looking at the actual underlying of the market. We're not looking at options at all in determining and looking at the red line. Okay, now, here's an important concept that I want us to get, and that is this. And let me just clear all this. Forgot I had this little tool here. Clear all my annotations. Okay, good. Let's just take a point in time. See, someone might say, gosh, let's just go back in time. Let me find a good spot. And let's just say that, let's say that we're here in time right now. Let's just say that we're like on this bar here. Okay? And we're thinking to ourselves, gosh, and some option educators would say at this point in time these options are overvalued at this point in time, right there. Let's just call that April 5th or whatever that bar would be, like right here. Okay? And a lot of educators would say, aha, these are overvalued options. Why? Because implied is, say, at 16, and yet statistical is at, say, maybe 13. And we have an overvalued situation. Let's go in and sell premium right now because those options are overvalued. Okay? Now, here's the problem with that. Here's the problem with that. Let me ask you a question. If we're sitting here on statistical, what is that statistical? Now, you don't have to answer this. Just answer it to yourself. What is that measurement of statistical volatility truly measuring? It's measuring the volatility that occurred over the last 20 trading days here. See that? Okay. Now, at that moment in time, let me clear this out again. Okay, so we have statistical is here at 13, switching colors. We have implied here, well, let's just round it to 16. Okay. Statistical is we said statistical, switching colors again, just quick to give us our little optical thing. Okay. That's statistical. All right. What is implied doing? At this point in time, on this particular day, what is implied volatility saying? Implied volatility, again, is the volatility implied in the time premium of the options. That number here is looking forward. It is an expectation of the future. It's telling us what we expect the market to do for the next 30 days. See that? And so when we take data as of this moment in time and labeling it, aha, options are overvalued, that's not really true. One is apples, another one is oranges, or blue grapes in this case. They're not measuring the exact same thing. Statistical is looking backward, implied is looking forward. And so we find that we really have to pay attention instead to the trend of statistical, because here's what can happen. Watch this. Let's say you go in and do a butterfly and you sell it at 16, thinking that you're selling this wonderfully, level of overvalued options premium. Okay, well then a month goes by. You did your butterfly. You may have had a campaigning and all that effort going on. Let's look what happened in the next month. We look up a month later. The market's up here. Okay, and we look at the statistical volatility. Switching colors again. Statistical volatility at that point that measures the previous month. Look where it's at. It's at a 19. So we sold at a 16. We look up a month later and market was at a 19. What happened there? Okay, well, you were just simply looking at the overvaluedness apparently at that particular date. Instead, what we need to look at are two things. And this is what we teach in our mentoring class, and we go over quite a bit. We take a lot of time on it, homework. You meet with a mentor to make sure you understand the concept and everything. There's two aspects to this. One is the chronic overvaluedness of the options. All right? Chronic overvaluedness, on average, is implied generally higher than statistical or not. And we want to try and focus on markets, Russell 2000 and others, typically where you have average, let's go blue, average IV, the average implied volatility, we want it to be higher than the average statistical volatility. If we were to look back, average statistical ASV, if we were to look back over years and years of time, we want to see situations where, on average, the blue line, on average, is higher than the red line. That would be chronically overvalued options. Okay, let me show you how that works. Let me show you in this. Clear my annotations. I'm going to come down here to this line right here. I'm going to click V. That's going to bring up the average numbers. Okay, watch this. Clicking V. And up comes this little chart right up here. Okay, take a look at that. Let me get a sip of coffee just a second. Okay, do you see how no matter, in this particular case with the Russell, and the Russell is a wonderful example, and this is why so many premium sellers, Condor traders, butterfly traders, even calendar folks, they like to use the Russell because it not only back tests out well, but it forward tests out well with real trading. But this is the reason why. And that's because these options are chronically overvalued. You could take a 6-year average of implied, and it is higher than the 6-year average of statistical, meaning that the options, the volatility implied by the options is higher than on average what actually comes to pass. And you could take other measurements, going back a 4.5-year average, 3-year average, 1.5-year average, the same pattern exists. So this is a great little situation here. So this would be a market where you would want to focus on selling premium. Now, does that mean that at any given time you could just load the boat, no matter what the volatility profile is, just load the boat on Russell and you're good to go? No, absolutely not. Absolutely not. You can't really do that. We also have to focus on the statistical volatility and its trendiness. Now remember, look at that previous spot that I took last time. Okay, I went here to where I think right about here or so. Okay, and look at statistical had begun trending up here. See that? It had begun trending up, and that was kind of a giveaway that maybe it was going to continue to trend up. Okay? It's just if the market is getting more volatile and it could continue to trend in that, and the volatility could continue to keep getting more volatile, it's getting higher. You want to maybe put pull back on the size of your butterflies, the size of your condors. If you guys have been educated well in how to make adjustments to your butterflies and condors, you may want to make those adjustment parameters a little bit more conservative, maybe taking in less yield. Okay, maybe making sure you stay away from danger a little more aggressively there. Most conservatively, when statistical is trending up, the market's getting more volatile, you could just back out altogether from that particular strategy. Okay, but in any case, it's always good to understand the condition of the market. And so that's something that we look at. And what I developed is, for us anyway, I developed something called the Lentz volatility indicator. And what you do is you load it up into the price chart here, and what it gives you is a histogram. And I won't get into it now. You can go look at some back issues of our OptionVue's newsletter, and you can go to the website OptionVue.com, look back there. And I think it was March of 11 that we initially rolled this out, and I had a real nice article in there that explained all this. But basically, it gives you a thumbs up or thumbs down for this kind of thing. And so when you have thumbs down, okay, that's when statistical is rising, and it's at a certain pace and place where we've deemed it that hey, you want to maybe back off on your the size of your condors or butters. Okay, when you get the histogram is positive, well, that's a thumbs up for that kind of trading. All right, so those of you into OptionVue, that's what that LVI stands for. You could look at the March 11 issue of OptionVues to kind of get a beat on that. But in any case, we want statistical. If we're going to do butters and condors, we want statistical to be trending down. Okay, so we want chronically overvalued options plus statistical trending down. Chronically overvalued, statistical trending down like this. So we're going to take those two concepts and go to OpScan now and look at some parameters in there that we can kind of toy around with, and let's see today what we get for butterfly and condor candidates. Okay, so let me do that. Let me do this and this. I'm going to go to OptionVue and go to OpScan. Oh, you know what I didn't show you? I didn't do the preview of the horizontal skew modeling. Just a second. Let me bring that up. I got to show you. This is so amazing. Watch this. I am going to go down to the bottom left corner, and there's this little M button there. You see that? Okay. I'm going to click that. Multiple IV lines. Ta-da! There they are. Multiple IV lines. The blue line represents a 30-day implied volatility figure, okay, from the options. We're taking from the options just a continual 30-day implied. In other words, if we always had a trading month in options that had 30 days to expiration, we take the average implied volatility of those options, or the near and at the monies, basically, okay? Then we also take, and I'm going to come over here and click. You're going to see here the volatility cones, like you see right there, okay? And that brings up this volatility cone. Now let me go, and I'm going here to, this is on the 5th. So I'm out here on the 5th, July 5th. So I'm going to go back and get my annotation here. This is we're just rolling this out here, testing it in the office, making sure everything's capiche. All right, now watch this. So we get we don't have just a blue 30-day line. The next line up, the green one, is a 60-day vol line. That means that every day, if there were a set of a series of options with 60 days to expiration, what would be the average implied volatility of those options near and at the monies? 90-day vol. We look at the options and have an algorithm similar to the VIX, calculating a 90-day number, 1-year number, 2-year number. And that's what these multiple lines all mean here. Okay? Now, it's important when we model options theoreticals into the future that we understand that when we trade an option that has a 90-day vol number, and we're going to predict what that value of that option, or when we look at options 90 days to expiration, you know, options that are out 3 months, and we're going to model how much you can make or lose on a trade, we need to know how much that volatility can change in the future. Okay? Now watch this. I'm going to grab this little wand here, and I'm going to drag it. And you could see how, look at how the vol numbers change. Okay, now watch this. I'm going to come over here to the beginning of, you know what, I'm going to come back to 11. This was really dramatic here. Let's just go. Remember when the market kind of took a nosedive in 11? Okay, you see that? I'm going to come here. Now watch this. I'm going to bring up the wand here. Look at the 30-day number is underneath the 1 year, right? And then as I'm going to go forward in time. Now watch this. As the market goes up, okay, as the market goes up, you can see that that's before at the top of that market right there. Look at this. The front months were trading at under a 20 vol. You go out further in time and they get higher and higher there. See that? And that's normal in a bull market, where the front month options have a lower IV than the distant month options. Now, as the market goes down, okay, the front months blow up because all the hedgers and the institutions rush in. They're going to go hedge their long portfolios. They start buying puts, and that pricing gets then arbed over to the calls, and the IV of the front options goes higher and higher. Now, watch this. I'm going to drag the wand as we go down in value, where the Russell goes from 860 down to 640. Watch this. Watch those lines shift as the market goes down. Look at that. And eventually, it inverts, look at that, to where the front month options now have a much higher implied volatility than the distant month options. See that? Now, by the way, the cone here, It's a 3-year volatility cone. These show you the highest level that over the last 3 years that the 30, 60, 90 has been. So somewhere over the last 3 years, the 30-day vol hit about 54%, 55% sometime. Okay? Sometime over, and then you could look at the 2 years. Sometime it actually went up to maybe 35 or so. So let's just keep going. Let's see if we can find the time that it hit that all-time. Oh, there it was, right? Boom, right there. October 3rd of 11 had the highest volatility readings in the last 3 years that you can see there. So that's what the volatility cone shows you. And it helps you understand how OptionVue models then options in the future. There's a lot more to this. We're going to roll out this upgrade here coming up, and more to come in the presentations here in the future. For now, let's go to OpScan. I said we're going to do that. Let's go to OpScan, and let's find Condor and Butterfly candidates. I created my little thing here, and I run this every week for our morning market huddle folks. I do a weekly show on Wednesday mornings at 8 a.m. Central Time, and I run this exact same OpScan every time we get together. Okay, so I'm going to show you the parameters, and this is the screen right here. Let me get my little annotation tool. There we go. Pencil. And a sip of coffee, just a second. All right. First thing. Now, OpScan, there is a formula language. It's very similar to maybe Excel. If you know how to run an Excel spreadsheet, you know, the language is somewhat similar to something like that. Fairly easy to learn. I have a little one-page cheat sheet that I use myself. Folks will call me up and say, Steve, I need help with this OpScan, or they'll shoot me an email, and I shoot it right back to them. You know, or folks in the office even say, oh, you know, how'd you come up with that formula so quick? Well, I have a cheat sheet. All right? I suggest it. If you use OpScan, you need to get our little one-page cheat sheet. All right? So in the pick line, this is where we establish a population of items to sort. So the pick line basically weeds out a candidate list. Even if the list is like thousands long at the end of the day, we can sort that list, and we're going to be creative about our sort line sometimes. But here, I want situations, AIV 500, that stands for Average Implied Volatility over the last 500 days. That's trading days, not calendar days. So that's roughly 2 years. So we're looking at basically a 2-year average. Basically a 2-year average of implied volatility, I need it to be greater than the 2-year average of statistical volatility by at least 5%. 5%, 1.05. That means that I want the ratio of AIV 500 to ASV 500 to be basically 1.05 to 1. Okay, so for example, let's see, what would 5% be? Okay, so let me just get this figured out. So if we have SV at 30%, okay, 10% is 3, 1.5. I would need, let's see here, let me get that right. If SV is at 30%, I would need IV to be at 31.5. Does that make sense? I need it to be 5% higher, at least. Okay, it can be more, but I need it to be at least that kind of a difference. 30% statistical, 31.5 S or IV. Okay, so I'm demanding there that there be a certain level of separation in the 2-year average of IV to SV. Now, look, you can take this and you can goof around with this. You can make this higher if you want, and that's fine. All right, you're just going to simply whittle down your population list as you do so, but that's entirely in the bounds of expectation that you guys would take this and start fiddling around. By the way, the 500 numbers, these can go up to 800 days. The OpScan database has saved 800 trading days of data along for those particular parameters. Okay, now let's talk about the next one. So this gives us the chronic overvaluedness, right? Chronic overvaluedness. Let's talk about this next parameter right here. SV is less than ASV20. ASV20 is the 20-day simple moving average. Okay? Simple moving average of statistical. So the 20-day simple moving average of statistical, okay, I need SV to be underneath that. I want SV to be trending down. Okay, so this speaks to declining or SV that's trending down. Declining SV. And that takes care of the two parameters we talked about. Chronic overvaluedness, statistical is trending downward. I'm throwing a little population filter in here. I need the index or stock to be at least at a 20. You could change that if you want, but I want there to be a certain number of strikes that I can play around with, and 20 is a good number for condors and butters to at least start with. You might want to raise that. Okay. I'm going to sort these. Those that meet these parameters, that are chronically overvalued and statistical is trending down, I'm going to sort them by their liquidity level, meaning I want their dollar volume, their 10-day dollar volume of options traded. Those that have the fattest dollar volume traded, I want to be at the top of the list. Okay? I don't want something with, that trades $5,000 a day in options popping up. I mean, on these 3- and 4-legged spreads, slippage will kill you. So forget that. I'm going to focus on the more liquid items. Okay, so that's our population pick. We're going to sort our population. In the show line, I'm going to display in columns the last price of the underlying. I want to see what the 2-year average of IV and SV is, or R, plural, right? Yep. Statistical, I want to see the current statistical and the 20-day average. I want to just see how much it's underneath its 20-day average there. I'm going to scan all stocks, indices, futures, the whole shooting match. I'm going to bring up the top 40 most liquid items that meet our parameters here, and away we go. Okay, so let me get rid of these. Let me just get rid of the annotations. I'm going to click the OK button here. This is the only one I have a little check mark next to, so I'm going to hit the Go button, and it is now running the OpScan report, and Shazam, it's done. I like to keep my OpScan reports. Maybe you can tell. I keep them. You know why? It's because I'll think in the back of my head, gosh, I know I ran that OpScan way back then. I wonder what it said back then. So anyway, you don't have to keep all of them. You can easily just get rid of them. But in any case, over here on the bottom right, you'll find the most recent OpScan report you ran. We always name them by the date and then the number ran that day. I mean, here you can go back to April. I ran 19 of them back then. But let's just take a look at this. And here's the report for today at this moment as we speak. All right. Let's see. Okay. Let's see. Here we go. I'm going to get a highlighter this time. All right. At the top, no big surprise here. SPX, if it matches the parameters of overvaluedness and trending and SV trending down, if it meets the parameters, that one is typically going to be always at the top of the list because it trades. In this case, look at that, almost $725 million of options. Now, make sure you don't use market orders in that puppy. I mean, even though it's liquid, that does not mean you can use market orders. Use limit orders, because the published spread between bid and ask in those options is crazy high. Okay, the liquidity resides within limit orders. So go ahead and use limit orders, and you'll get filled pretty well. So, just word to Word to the experienced and wise. All right, Spider. Okay, 188 million in options trading. Pretty good, but you can see here that we have a pretty good separation on a 2-year, and you have the trending down. And you could just go down the list. Now look, you get some stocks thrown in here. Okay, Google. What other stocks coming down here? Priceline, Cisco. Okay, now if stocks are in here and you want to put on these spreads in these stocks because, let's face it, the implied volatility of some of these can be a bit higher than what you'll find in the indices. Make sure you don't do it in a month where you have earnings coming out. Condors and Butters, don't put them on in an earnings month thinking you're going to go to expiration. If you do, make sure you understand how much it can gap. Look at this inner oil. Look at that IV number, 78 compared to a 65. Real nice chronic overvaluedness. Just be aware of what's going on. There's a reason for that separation. Make sure you understand earnings, okay, when earnings are coming out and the ramifications for it. I would stay away from some of these souped-up ETFs, okay? That kind of, lends to a higher IV because it's so souped up like that. I'd steer away. But anyway, this is the list that we have now as we speak here, okay? And, I think those of you that like to do this in indices, right now it's looking fairly decent. You just have to kind of, now sometimes these fall off. These will fall off because statistical begins trending upward, and this little parameter here, it's gone. Okay, so just watch that. Let's see. Jerry is asking, Steve, can we sort by the difference between AIV and ASV so we get the largest differential? Jerry, yeah, you certainly can. You could change this sort line up here, and you would sort. You could say you want to sort by the difference and just simply put in AIV 500 minus ASV 500. And that would be sorting by the difference. And the positive numbers would pop up at the top. The highest positive values would be at the top. The sort value always has the highest positive value at the top here. Now, Jerry, if you do that, you're probably going to want to put in up here in the pick line some kind of a dollar volume options traded filter, because we're using the sort line here as kind of a filter. We're only dealing with the top 40 that meet the parameter here. Robin is asking me to not highlight. Is that messing up your vision there? Is there what you can see? Okay, I'm just wondering if it's messing up with the way you see things there. Okay, I just kind of want to... Robin is saying yes, big time. I'm sorry, I didn't know that. Let me clear it all out. Boom. I'll just use my little, now let me get rid of annotation. Now I'll just use my little arrow, okay? Sorry about that. Okay, so any other questions on that? Jerry, that was a great question. Rodney is saying this. It seems when SV is trending down, stock is trending up, which would be bad for butterfly spreads. Rodney is saying it seems when SV is trending down, stock is trending up, which would be bad for butterfly spreads. Well, that could be the case, Rodney, and let's assume that it is trending up. Okay? Hopefully, you would have a good adjustment approach to your butterfly strategy. But keep in mind also is if SV is trending down, underlying is trending up, you're also selling at a premium higher than what will actually be incurred by the underlying asset. And if an equity or an index is trending up, typically the daily bars are narrower, right? And so in that case, you're going to incur then the volatility edge by selling fatter implied than what you'll incur in the underlying typically. Now, look, I know sometimes stocks and certainly in indices, you can have big up days that can mess things up there. We know that, okay? But you can in any market, certainly. So, but what I'm saying, though, is that your volatility edge exists in that uptrending more than it would be in a downtrending market where SV is going higher, and it will turn out that you sold premium for a much cheaper level than what actually was incurred. Hope that makes sense. Okay? But certainly, in a trending market, when the market's trending, you have to have, with all your approaches, non-directional, adjustment plans in place to execute. And that's what we teach in our mentoring, is how to adjust when the market trends in one direction or the other. Now, what happens if you're not using OpScan? What can you do, okay, if you don't have OpScan here? And in OptionVue, what I would encourage you to do is to just dial up or put all of the underlying assets that you're interested in a particular group. And let's say that you like to just trade ETFs. Now, I would suggest that you create a group in OptionVue, and it would just be the group of underlying candidates that you like to address. Now, next time we get together, I'm going to go over how to come up with a good candidate list of extremely liquid extremely liquid options. In other words, what are the top 12 or 15 assets whose options are the most liquid? And that's what I'm going to address next time. And I'll show you how to do that, and we'll come up with a list at that point. But let's say you have a list of items that you like to look at. What you do is you bring up the price chart and bring in the volatility. Now I'm going to get rid of the items there. Okay. And what you're going to do then is bring up the V button and look at the averages here and scan these, and you go, okay, Spider, that looks pretty good. This is a chronically overvalued set of options. And then, well, last 3 weeks it hasn't been. But long term, you could see there's a degree of separation a little bit. May not rank that high, the 6-year average, but the other ones are pretty darn good. So you write that one down. Okay, that's good. Now, come up here to the top here. It says Browse Previous or Next. I'm going to click on the Next button. It takes me to the next item in my pre-planned list here, IWM. And now I can look at here and make a judgment as to whether that is chronically overvalued, the level that I want. I can also then look at SV. And if I'm using OptionVue and I like that Lentz volatility indicator, you could dial that up as well. And in this way, you just click the Next button, and you just start marking down your, look at this, EEM. Look at how chronically overvalued those options are. Okay, LVI has been pulling back. It just turned positive. You know, that might be a candidate for something more non-directional. Let's click Next again. And in this way, folks, you can just simply click through, okay, the candidates that you like to see. I mean, look at this, GDX, gold. Look at that. Look at that chronic undervaluedness. Look at that. Gold is chronically undervalued, as you can see here. Click through, and then this way you can scan a whole bunch of these without using OpScan. Now, you're not going to get the quantitative analysis that you'll see, but at least this enables you to quickly flip through and get a bead on some underlying assets that might be pretty good candidates for premium neutral selling. All right? Just like that. All right, anything else? Any other questions, comments? All right, let's go back here. Click this. Can you repeat the SV-ASV definitions? Statistical and average statistical. Sure, let me share with you my desktop again and go back. From Robin, real good. Let's bring this up. Okay, let's go into OpScan, and let me go into that last report we just did, right? All right. Okay, so we have ASV, okay, and over here you have SV is statistical volatility. That's in the show line right here. ASV 20 is the average statistical volatility over the last 20 days. And 20 is the highest we go for that particular parameter. No, that's an 800 number. We can go up to 800 there. Okay, but in this case, you can see statistical is underneath ASV 20. In all these cases, SV is trending down. It's underneath its own 20-day average. Okay? Jerry says, I put in the sort, look at EIG, KAR, NVE. Well, you can get some pretty big, let's go ahead and look at that, Jerry, real quick. This is where EIG. Alex is asking, for these candidates, are we selling or buying butterflies? Alex, a butterfly that results in a net positive theta to you, time decay coming into your pocket every day, that's a net debit trade that you're buying. You're buying a butterfly. That's the advantage of butterflies. It's a spread that you're buying, yet you're incurring some positive time decay like that. Okay, KAR, NVE. Okay, see, Jerry, here's the problem with doing that. I said you had to put in a DVO filter. Look at this. EIG trades only $4,000 of options a day. KAR doesn't even have 1,000 a day. And NVE is at 4,000 a day. That's why you'd have to add to that filter there definition for there. And you do have to get the language right, other you'll get a syntax error like you just said, like you just wrote. Yep. And so what I can do is actually go in and shift that around. Let me answer a few questions, and then Jerry, I'm going to go in and show you how to redo that. Okay, so I answered Alex's question. From Susan, can you repeat what the LVI should be doing when SV is declining and IV is relatively high? Okay, the LVI should give you a thumbs up or be at a positive value whenever SV is declining. Okay, it has nothing to do with where implied volatility is, Susan. It's only related to the trendiness of statistical. So, for example here, when statistical is trending down like this, now it popped up a little, well, that's with today's thing, but you can see when statistical is trending down, the LVI is going to eventually come positive here. We're not, the LVI does not look to implied volatility at all. Okay, doesn't even look at it. Now, let me show you here. I'm going to take Jerry's suggestion, and I am going to, let's see, where's my little check mark there? Okay, and I'm going to copy this, and I'm going to redo the sort line for him. So I'm going to call this Lentz non-directional 2. Lentz non-directional 2. And I'm going to change the sort line. And first I'm going to put in a filter. If I'm going to get rid of this filter, okay, I'm going to put it up here. And I'm going to want the 10-day dollar volume of options traded to be greater than $1 million. That would be, it's in thousands of dollars, so I got to put that there. Now I'm going to go to the sort feature, and I'm going to address this item here. Okay, meaning I almost really don't have to have this. I could put in AIV 500 minus ASV 500, and I could sort these just simply by the absolute value, okay, of the difference. Now, is that going to give us the best items, or aren't we going to want to make it relative to the statistical volatility number? I'm going to say that. I really think we can't just take the absolute difference. I mean, what if you have a 5-point difference and ASV is at 300 and the other one's at 295? That's not much of a difference, but a 5%, 5-point difference, if it's at 15 and 20, that'd be a whole different story. Okay, so what I'm going to do is glob this together, and I want this number to be high and I want statistical to be low. So I'm going to take ASV. It's going to be relative to the current average statistical volatility number. Hope that makes sense for you. Okay? Numerator, denominator. I want the numerator to be high. I want the denominator to be low. Okay, now I come over here to test syntax. Whew, on the fly. Okay, here we go. Let's try this. Non-directional 2. I'm going to run non-directional 2. Hit go. Hope this works. All right, there we go. And a bit of a different story, isn't it? Look at that. Okay. Did this work? Yeah, look at that. These are some fat differences. I didn't list the dollar volume of options traded though. So I'm going to back out and I'm going to go back and redo that thing. You're saying, no, look at the list. No, all I want to do is add something. We're going to rerun it again, okay? It drives me crazy when I don't see the actual dollar volume of options traded. Because I just don't want to, I know I don't want to waste time looking at something that doesn't trade much options. Test syntax, good, go. Number 3, there we go. All right, EFA trades 8.5 million a day. Here you have real nice, juicy chronic overvaluedness. SV is trending down. That looks pretty good. ARM Holdings. IOC, we have a lot of students. They're doing very well with that thing. I don't know earnings, what the situation is there. Okay. And you know, some of these aren't going to have the most liquid of options. You know, VRX, I would imagine, is not near as liquid as Google would be. But at least it trades over 1 million in options, and you got some market makers working it, and you can get executed. Okay, it's just that some of them that are low, like 1 million, 2 million, you're going to have to work the order a little harder on the limit orders. Okay, so just be aware of that. Okay, but that's a pretty good list there. Pretty good list. All right, thanks a lot, Jerry. All right, folks. Hey, thanks for joining us today. We'll be back next week, next Monday, with another mentor in this series. Take care. Have a great rest of the week. Enjoy the summer. Be safe. Bye-bye.